All right, I'm letting people in. We still have a few minutes before we officially start here. I guess a little more than a minute, but I wanted to get people in. We had a pretty big sign up. Apparently, as I expected, a lot of questions on ERC still, probably tax season, bringing things up like this. So another minute, maybe a little bit after top of the hour, we'll start, but we got people coming in now. So in fact, I'm going to go take a look at the attendee list. All right, yeah, recognizing some names here. All right, glad you're all here. Looking forward to this one. Haven't done a specific ERC in a while, just ERC, so it's kind of exciting for me to do this. And there's a lot of questions out there that we'll discuss today, and a lot of misconceptions going on out there. We'll discuss as well. Just going through, but another less than a minute and we'll officially get going here. Kind of a new slide deck, so hopefully I got the timing down right on here. We shall see as we get into it, but we always will always be there for questions that come up during the presentation as well. I just see Mike Crabtree's on there. Every time I see that name, I think it's my son, who's also named Mike Crabtree, but this is not Mike Crabtree, my son. This is Mike Crabtree out of Minneapolis. Mike, good to see you. Glad to see you're here. All right. Well, we have hit the top of the hour. Let's start with some of the just generic slides to get going, and then more people will be logging in. We got a decent crowd already. All right, well, welcome everybody to TriMerit's webinar series. And I say that today, which I haven't traditionally said that, because we have some big announcements on TriMerit's webinar series that I'm going to talk about at the end today. So if you can, stick around a few minutes at the end, because I think we got some pretty exciting news coming out today. Current updates to the employee retention credit. When I say current updates, there hasn't been, I guess the last notice came out the end of last year, but there's just been some current issues that we've run into as we're doing studies. There have been some things that have come out in other areas of the tax code that's affecting us. So we're going to talk about that and the overall interplay between taxes, income taxes, payroll taxes, other credits as well. So that's the title of today's presentation. As always, if you were on my last presentation, you realized I messed up and forgot to put the polling questions in. Today, we did not mess up and forget to put the polling questions in. Everybody still got CPE last time, so no big deal. But we do offer CPE for this. Answer 3 of the 4 polling questions. Stay logged in for 50 minutes. And if you do have any questions when we're going through the presentation, please type those in the Q&A tab. I haven't asked this, but I usually do. Make sure you hear me. I'm sure you do. Make sure you see my slides. Tell me in the chat, a couple of people, that you hear me and you see me, just so I know I'm not talking to a blank wall right now, which I'm assuming. All right, good. We see chats coming in. Hear and see. That's a good combination. Thank you. We have a new process in place. I'm going to get this wrong, but the CPA certificates will be more automated. You'll get an email where you'll be able to go download them, I think is the way it goes. Mark Reese, who's our head of marketing, has done an awesome job of starting to get this stuff more automated. And so as we go forward, this is going to be probably an easier process for you to get the slides and to get your certificate. So you will get that, and it will be the email that you registered with where you'll get that information. With me today, you can see him live. You can see his picture here is Nick Pantaleo. Nick is a CPA. He's also, I call him CFO. I don't think that's officially his title. He's pretty much a jack of all trades at TriMerit, but HR and CFO are really a main role. Nick's been with us for over 10 years now, which is amazing, because look at him, he's only like 15 years old. So he's been doing this. he's got the beard, so he looks older there. But Nick's been here a while, and he's been very instrumental in the employee retention credit on all aspects of it, but specifically the 941 information too. So he's going to address some information on the 941 filings and 941Xs at the end of the presentation. So Nick, thanks for being part of this. There's me. if you've been on these before, I'm a CPA. I came out of public accounting, started TriMerit 15 years ago. And yes, we are about 2 months away from our 15-year anniversary, which I'm very excited about. We do this webinars. I host a podcast called the Unique CPA. Very exciting information to share on that at the end of the presentation today as well. And I'm very honored that Accounting Today recognized me as someone to watch as one of the most influential people in accounting this past December. And that's really a company recognition, but they single out one person. So that was me. We also write a lot of articles on things important to the profession. All right, enough of that. TriMerit, we support you. We support tax preparers by allowing you to be able to bring specialty tax services to your clients. This is you bringing these to your clients. This is you as the preparer bringing tax saving opportunities. We're there to support you and your clients, and we're behind the scenes. Obviously, they know we exist, but we're behind the scenes supporting you in that. We are made up of engineers, scientists, CPAs, attorneys, and we have offices now. I think it's 14 states. We cover the entire country with what we do. Agenda is pretty easy. It's ERC. It's ERC. We're going to intermingle things that have been going on recently in the discussion. We'll have specific slides that are new information or clarification on information. And we're going to talk about misconceptions, because there's a lot of misconceptions going out there that I'm running into daily, honestly, with the employee retention credit. In fact, I did a presentation for the New York Restaurant Association just this week. And the first email I got off of that was, my tax preparer told me because I had a PPP loan, I can't get ERC. Common misconception. I assume most of you know that is inaccurate, and we'll talk about that, but there are a lot of misconceptions with the employee retention credit. And we're going to talk about an interplay that's going on with other credits. This interplay we've always known about. 2020 was different than 21. Now we have the first half of 21 different than the second half of 21. And we're going to give an example on how that plays and what credits that involves. Before we even get started, we're going to go to a polling question. So let me pop this up. I'm launching the poll right now. Everybody's paying attention, right? This is a personal, I was on a podcast today. The question is, what do you think is a better descriptor of our profession? Accounting industry, accounting profession, accounting sector? I personally want to know this because I was getting corrected often this morning on a podcast I was on, and they were saying, and good-naturedly, but saying I was using the wrong descriptor, and I probably was using the wrong descriptor. Let's see, we've got 83% of you have participated already in answering this question. I'm going to go just another 10 seconds. We're at 89%. Somebody just changed their answer because it was 87, 89, 87, 90%. 5 seconds. I'm going to stop this. So if you need CPE, make sure you answer this question. And if you don't, make sure you answer the next three. 92% done. I got 3, 2, 1. We're ending the poll. And I'll just read it to you. 80% say accounting profession. That's what I was doing wrong this morning. I was saying accounting industry. I don't know why. It's just been part of my vernacular for a while. I am correcting that to accounting profession. Thank you for your input. And let's move on now. So ERC is what we're talking about. We have a ton of guidance on ERC. Is it enough? It's not completely enough. You're going to see as we go today, it's not completely enough. There's still questions out there. Some of them we have our opinions on, and we'll give you our opinions. Some we're going to just have question marks on and say, hey, if you know, you let us know, but we're going to have opinions on most of these. But you can see all the legislation. I mean, there's been 4 pieces of legislation that have affected the employee retention credit. There's been 4 notices. There's been the FAQs. There's been a lot. So we have a lot of information. We're very comfortable with most of what's going on with the employee retention credit. And hopefully we'll be able to share things that'll clarify things for you today. I'm going to give you a little background on the history, because this is where misinformation comes from. This is where confusion comes from. There is plenty of confusion because of some of this. Real quick, you all know this was defined in the CARES Act. You all know I hope, and well, if you don't, we'll correct this now, but you all know when this originally was defined, you could not do the PPP loan and the ERC, mutually exclusive. You couldn't do both. You all know the CARES Act defined this as a 2020 credit, March 13th till the end of 2020. That was it. Well, that changed with the Consolidated Appropriation Act. Big change. It extended it for 6 more months, end of June of 21. It enhanced the benefit. Instead of a 50% credit, is a 70% credit. Instead of an annual credit, it's a quarterly credit. But biggest change that happened is it got rid of the PPP ERC exclusion. They weren't mutually exclusive anymore. You could do both now, retroactively to March 13th of 2020. Then American Rescue Plan came out. American Rescue Plan says, all right, we're going to extend this 2 months further, end of 21. Credit exists now. Then, not now, because we'll touch on that in a second. It defined a few different ways you could qualify up and above the original definition, which was recovery startup businesses, which we'll touch on today because there's some interaction that we want to talk about with that. And then it defined severely financially distressed employers that came in. In addition, very important, the audit period was extended from 3 years to 5 years. So IRS has additional time to look at this. And IRS, if you listen to the commissioner, I think it was last week, IRS, he's telling us they are going to be caught up with everything, not just ERC, everything by the end of this year, which seems to me to be a very daunting task. But he has confidence that that's going to happen. And I don't know the numbers now, but I think recently they hired an additional 3,000 people, maybe what it was. I think 5 was the goal. Maybe 10 was the original goal. Maybe they brought that back to 5. But the last I heard, they have added 3,000 people, which, everybody's having a hard time finding people. So if they added 3,000 people, that's pretty impressive. What are they going to get? Who knows right now, but they're doing that. So that audit period is important to know. Last piece of legislation that is currently affecting the Employee Retention Credit is the Infrastructure Investment and Jobs Act that came out the end of last year. This pulled part of the credit away from us. I was going to say stole. This took away the fourth quarter credit for everybody except recovery startup businesses. Recovery startup businesses can still claim the fourth quarter, and we'll talk about that in a bit here. There is a proposed piece of legislation that is not, this is getting traction. How significant traction? It's not to the level we were hoping yet, but the Employee Retention Credit Reinstatement Act. This is proposed. It's out there. It is written. It is have strong support. It's just the problem is, we have both Democrat and Republicans for their own reasons, not sure they want to show that we need more support in certain industries. White House saying we have a strong economy, Republicans saying we have big inflation. These things working together is really putting a damper on this getting passed. But this Reinstatement Act, if it does get passed, and I think the next month is key for this, if this does get passed or makes it on some other legislation, it would reinstate the fourth quarter. Fourth quarter would come back. Now, fourth quarter in general was not good for certain industries, but restaurant industry, again, got hit pretty hard in the fourth quarter. I think the percentages were in a recent National Restaurant Association survey that I think it was, I may be misquoting here, but I think it was nearly 60% of the restaurants that submitted information to this survey said that they had a 20% drop in revenue, at least a 20% drop in revenue in the fourth quarter of 21. Restaurant industry is pushing hard for this reinstatement. They have a big lobbying push that's going to go on in April. That's why I think that's going to be a key month for this. They're a great lobbying group for this, and it's needed for that industry. All right, that's history. Let's get into the whole how you qualify. We need to set the stage. If you've been on webinars of mine, you've seen this before, but we'll touch on it because this is important, because there is misinformation. There's misunderstandings around this as well. To qualify, and I still hear this misquoted, I was going to say daily, weekly at a minimum, but more than weekly. I get this misquoted. to qualify, one of two things. I either have to show a significant drop in revenue in any quarter in 20 or 21, and we'll define that later when I compare to 19, or I have to show that my business has been restricted by a government mandate. I have been restricted in some level. That's an either or. It's not both. So just keep that in mind. I can be under restriction and have an increase in revenue. That can happen, and we'll talk about scenarios. So just because there was no drop in revenue doesn't mean I don't qualify, and I get that a lot. Hey, we looked at the financial statements, revenue went up, we don't qualify. It's a good indicator. It's not the only indicator. Was there a portion of your business that was affected? That could bring this in. Where we currently sit then with the value of the credit, the value of the credit was an annual credit for 2020. That annual credit was 50% of the first $10,000 of wages available or qualified per employee. So up to $5,000 per employee credit for the year 2020. Year 21, it's $10,000 of eligible wages per employee per quarter. And now 70% of that first 3 quarters, unless we're a recovery startup business. So let's assume we're not recovery startup business. The potential there is 21,000, 7,000 a quarter per employee, 21,000 if we qualified for all 3 quarters. Quick math on this. And this is what I use this example a lot, and it's astounding how quick the numbers grow. We have a 10-person business here, 10 people. Let's assume they each earn $10,000 during the qualified period, whether it's the 9.5 months of 2020 or it's the quarters in 21. If they qualified for that entire period, 9.5 months in 2020, first 3 quarters of 21, their total potential credit is $260,000 for a 10 employee company, small business, $260,000, over $250,000 available for this business. That credit, and you've heard this and you know this, but credit here is not, let's use it against tax. And Nick will expand on this when we talk about 941s. Credit here equals cash. We have this credit, this is the cash we're going to have. And the cash comes in the form of a refund check from the IRS. So that's why this is such an important area. A little bit more on the background, then we're going to start to intermingle the changes or the updates. First, 50% drop in revenue in any quarter in 2020 compared to 19. That's how we qualify. Safe harbor. I don't have to show that revenue drop. And this is a misconception. Well, do I have to show that revenue drop is because of COVID? No, you just have to show there's a revenue drop. You just have to do the math. You just look at the numbers, compare them, do your Excel spreadsheet, and then 50% drop in any quarter. Okay, I qualify. You actually automatically qualify for the next quarter too, and it's easier to qualify for the quarter after that in the year 2020. The year 21, all I have to show is a 20% drop in revenue in any quarter. Again, when I compare to that same quarter in 19, if I do that, doesn't matter what that revenue drop is, I qualify. And let me give you an example here. 2019, we have a nonprofit that got a big grant. Revenue was high. Grant revenue is included in revenue for nonprofits. Revenue was high in 2019 because we got this big grant. 2020, 2021, we didn't have the grant. We operated as normal. We didn't have the grant, but the revenue shows this drop because we had this big revenue in 19. I don't have to prove that that was due to COVID, that revenue drop. There was a revenue drop. I've done the math. That qualifies. That's a safe harbor rule only. Oh, this polling question 2. Yeah, it's about time for polling question 2. Let's put this up right now. I don't think we have any polling questions that I put in here that are specific to today's presentation. I just wanted to put fun ones out there. So, who will win the NCAA tournament? And I didn't put a I don't care in there, so you have to vote for one. So Duke, Villanova, North Carolina, Kansas, who is going to win this next Monday's tournament? We are at 66%. And you know what? You don't obviously just pick an answer because you just need to get this answer in there. But just so you know, there's no unanimous choice here. There's not even anybody that's getting 50%. But as of right now, with 89% of you, 91% of you participating in this, there is a clear favorite that you think will win. And if you're right, I will win my bracket. And so I'm going to end this poll in 3 seconds here. 92% of you have participated. So we're about to end this poll. And I am ending it. And 38% of you think Duke, 28% think North Carolina, 20% Kansas, and 14% Villanova. My partner at the Beer Temple in Chicago would be very upset because he's a huge Villanova fan, but I'll be happy if Duke wins because I will win my pool. All right, thanks for that. Let's move on. All right, so drop in revenue. This is questions that we get now. Well, what is revenue? What is revenue for figuring this out? Well, I'll tell you what is not revenue. I don't have to put PPP forgiveness as a revenue. That is not a revenue when I'm comparing 2020 or 2021 to 19. Shuttered venue operator grant, restaurant revitalization grant. If you got prior ERC refunds, not revenue. Don't include that. Here's my operating revenue. That's and I think it's interest, dividends, capital gains. I think I should double check that. But here's my overall revenue. These things I do not include. What we have seen recently is most state grants have been included as revenue. And so we have to look and see if there was other incentives out there that your client received up and above these other grants. I'm sorry, there was a question that came in here, came in the chat. If you can try to put the questions in the Q&A, we will look at the one that came in the chat as well, but the Q&A would be a better spot for that. All right, so these are the things that not, and then some things we have to include in revenue. Big question we get, and this was clarified in, I think, 2149. The basis of accounting we use to determine the drop in revenue is the basis of accounting we use for income tax purposes. So just be aware of that. Now, this is information that we need to touch on today. This is new stuff. This is questions that we're running into and what we're seeing as the answer. How do I determine my base period revenue? Because there's different scenarios. I owned a business, I didn't, I added a business, I purchased a business, I started a business. How's that going to affect my base period 2019 gross receipts that I can compare 20 and 21 to? So let's go through some scenarios here. We are in that update section of the presentation now. In case any of you were sleeping through the first half or first third, do not sleep through it. We have a scenario where there's no aggregated group. We have one business. It was in existence all of 2019. Very simple. I compare whatever quarter I'm trying to qualify in 20 and 21 to the same quarter revenue in 2019. Easy. Do we meet those requirements? We qualify. 2, no aggregated group again. Let's assume just I've got one business. I was not in existence all of 19. We started, let's say, in third quarter of 19 into this scenario. How do I qualify or compare second quarter of 20 to second quarter of 19? Because I didn't have any revenue in 19. Well, IRS tells us, look at the quarter you started in. What's the quarter? Average that out for the entire quarter. Wow, I was stumped on a word there. Average that out for the entire quarter. So if we started in the third quarter, let's say we started mid third quarter, what we're going to do is we're just going to average that out as if we existed the whole quarter. Then I'm going to use that for my base period when I compare it to the first, second, and third quarters of 2020. So that's going to be my quarter that I use for revenue drop for those first 3 quarters. After that, I will have a full quarter of the fourth quarter of 19. I will have a fourth quarter of 20. I'll do the comparison as normal going forward there. So that's a pretty straightforward scenario. Questions we get on that a lot. And so I just wanted to kind of clarify that. Now, let's assume that we have an aggregated group. We have more than one business. So how does that affect, my base period gross receipts? Base period being 2019. Well, if all 3, let's assume there's 3 businesses. If all 3 businesses existed in 2019, the entire year, and we have all 3 in 2020, it's pretty straightforward. Add up the gross receipts for all 3 for 19, second quarter, let's say, all the gross receipts for all three, second quarter of 20, do the comparison. Do I meet the 50% drop? That's straightforward. Now, let's assume I started a new business after 2019 or later in 2019. Well, how does that affect my base period calculation for comparison purposes? Well, if this new business is simply, let's say, an extension of my existing business, let's say I have 2 dental offices and I add a third. It's really not a new business operation. And so what we're seeing is that in that situation, there is no, let's assume new dental office started in the fourth quarter of 19. Well, for those first couple quarters of 19, what we have is we don't have any revenue from the third dental office, and we don't get to pull in some kind of interpreted revenue based on when we started. That's what we're seeing. The way we're interpreting this is this existing business, if it's simply an extension of the existing business, won't affect base gross receipts until it was in existence in the base period. So let's assume you started the third quarter of 19, second quarter of 19, you're going to have 2 businesses to add up gross receipts. Second quarter of 20, you now will have 3 businesses. You're going to compare these 3 to these 2. Probably going to be hard to hit the safe harbor drop in revenue if this third business added a lot of revenue. So that's just the scenario we're seeing. That we feel is the right interpretation of this. Now, let's say that it's not an extension. Let's say you had 2 dental offices and now you started a McDonald's, whatever it is. You started a totally separate business. Well, in that scenario, we feel we could follow these startup rules where new business creates its own base. I'm going to compare second quarter of 20, let's say the third quarter of 19, or fourth quarter of 19, if that's when we started. That's its own base. Take those numbers and add it to the original. I had revenue for second quarter of 20 for the original 2. I had revenue second quarter of 19 for the original 2. Those are my base. Add my new business base to it for whatever periods we use. Boy, this is sounding confusing, isn't it? Bottom line is, in that scenario, we feel comfortable that you can do this mixed base calculation and put these together. Now, is this guidance that we're basing this on cut and dry? No, it's based on different forms of guidance IRS has given us. And it's just a matter of the ordering that you take their guidance in. They have not melded this guidance all together. What they've said is, okay, here's how you calculate the base for a new business. Here's how you calculate the base for an aggregated. And then we're kind of melding those, and it's a timing issue. And Nick, I didn't know if you had anything to add to that, or am I making that clear?
No, I mean, you explained it pretty well. It's a complicated situation, and we don't know the perfect way to move forward. But when you meld those things together, you kind of have a conflicting view. And is that conflicting view is purely based on what's your order of operations when taking that guidance. So yeah, you need to look at it as an entire group and determine, can the entire group qualify with the gross receipts? But are you taking the entire group and saying the entire group's base period is 2019 quarter 1? And this business wasn't even in existence, so they get a 0 for that quarter? Or are you saying this company that started in 2019 Q4, we get to take that Q4 2019 plus the other 2 companies Q1 2019 and compare those together? So it's not cut and dry with how you're supposed to do it. We think there is an argument to be made to be able to take this approach. We haven't had a client where we've had to go forward with this approach, but it is out there as an option.
And just so you know, Nick, let's give them some numbers. At this point, we've filed 1,600 941Xs, or no, we've helped 1,600 clients, which is going to be multiple 941Xs, correct?
Yeah.
And what are we at? About $170 million that we've helped tax preparers save their clients?
Yeah, it's approaching 200 million.
200 million in savings. So we've done a lot. Quite at the point was we've done quite a few of these, and we haven't specifically used this methodology. We feel comfortable with it. There's a lack of guidance on it. We have something to hang our hat on, but if we can qualify them, let's say under suspension rules rather than the gross receipts rules, we're going to want to do that just to be, it's more cut and dry. All right. Thanks, Nick.
Mm-hmm.
All right. The next one is, let's assume that we purchased a business. How does that affect us? Well, the interesting thing is IRS has said, whether you did a stock purchase of a business or an asset purchase of a business, in order to qualify under the safe harbor rule, the drop in revenue rule, we have to have the prior owner's gross receipts. So we need that back information to use this methodology, the safe harbor rule. If we don't have that, we just cannot use the safe harbor rule. The only thing we could do is see if we can qualify under suspension rules. Now, if it's an asset purchase, we don't control those past tax returns. We control what's going forward. So that's our opportunity. If it's a stock purchase, I think we've got control of those past returns. And if the past owner didn't take advantage of these credits, we can still go back and amend the 941Xs potentially. The problem would come in is if it's a pass-through entity, we're changing K1s, because we have to pick up, there's an expense reduction when we take the credit. If we're changing the K1 to a prior owner, there's some complications that comes in there, but straightforward, we control this information going forward in a stock purchase. All right, that's gross receipts. That's some new interplay we've seen with the gross receipts. Let's just talk quickly about the suspension rules because there is confusion here. And I'm going to use an example here. And you may have heard this example before, but suspension rules, all right, I'm going to go on a soapbox for a second. We are going there. I've seen some people try to go way too far with suspension rules and get way too liberal. And this is my opinion. What the suspension rule says is I have to have my business restricted by a government entity. A CDC recommendation is not a government order. OSHA interpretation or implementation of CDC is not a government order. There's been a lot of talk about OSHA creating a nationwide restriction on businesses, and therefore everybody in the nation qualifies. That is not accurate. And this is my opinion. People can have their own opinion. I think that's a very, very thin line, if any line at all, to stay on. So we need to show we had restrictions placed on this business. Now, this is not as hard as it looks for certain industries. And in reality, I only have to show that 10% of my business operations were affected by this government restriction. And this is an example that I'll share because I talked about this at the beginning. At the beginning, I said, you don't have to have a drop in revenue overall to show that you were under restrictions. Anybody that's heard me talk about ERC before has probably heard me talk about this scenario, but it's, I think, a great scenario to get your mind around what does that mean. I'm partner in a craft beer bar and liquor store in Chicago. That craft beer bar in Chicago was under restrictions March 17th, 2020, June 11th, 21. We had capacity restrictions that entire time, well over a year. The revenue in the bar significantly down. The revenue in the liquor store significantly up. One, people just taking stuff to go home. Two, we added new services of local deliveries. We added new service of nationwide deliveries, and we added new service of virtual craft beer tastings. And some of you may have been on some of those with us because we personally have done that as well as the bar. And so revenue, if you look at the new service line, virtual craft beer tastings, you look at the liquor store up. If you looked at the financial statement 2019 here, 2020 here, 2021 here, overall revenue increase. But because there was a significant drop in revenue or restrictions placed on the bar, entire operations comes into the calculation of the credit. So you as the advisor, you as the tax preparer cannot just look at the financial statement and say this client doesn't qualify. You have to dig deeper because of a portion of that client is affected. Medical is another good example. medical, dental. You could do, if some of us had needed a root canal or lost a tooth, you could do that, but you couldn't do cleanings in a lot of places. A portion of their business was affected. They were under restrictions. So that's what I'm saying. Look at that. But we have to show that there was a restriction. We can't just say, and I see this a lot, hey, there's masks mandate here. We all qualify. No, that had to affect you some way. The OSHA rules, no. We had to work from home. We qualify. And I've seen this where people are qualifying businesses this way, and I get frustrated. You had to, all your workers had to go home and work from remotely? You qualify. No, you had to have an effect by that. If I could flip the switch and I can go work remote today or tomorrow because we couldn't go in the office, that's not enough. We have to be able to somehow quantify there was an effect to your business. This is another soapbox item. Supply chain. And I want to address this because this is a big issue just in our economy. And in fact, I think the president just addressed this in a speech or in maybe some in his new tax proposal, maybe. I'm not even sure where it was, but it may have been there. Supply chain issues. Everybody's heard it. Everybody knows it. Everybody sees that there are supply chain issues going on in our country. Just because there's supply chain issue, and so just because that is affecting you as a taxpayer doesn't mean you qualify for this. And we'll expand on that. You have to show that this supply chain effect was directly because of a COVID restriction. My supplier was ordered to shut down. I could not replace any of these supplies with any other supplier. Therefore, I have been affected. You can't just say it. You have to prove it. You have to have the mandates. You have to show that they were under a restriction. And that's not always the easiest thing to do. Suppliers in general may have self-limited production at the beginning of the pandemic. They may have reduced hours. They may have reduced employees. They didn't know what was going on. They were going to try to save money. That alone has reduced the number of supplies available. That's not enough to qualify you for the employee retention credit. I've seen people say, well, we can't get employees, so we qualify. No, there has to be a reason. There has to be a government mandate that doesn't allow you to get employees that would qualify, your suppliers not being able to produce the materials. A lot of supply chain issues, unfortunately, and I don't honestly know if we've qualified any businesses under a supply chain issue. If it has, it's been less than 1%. Supply chain issues are out there because, one, like I said at the beginning here, people self-limited production. Two, demand obviously went crazy the last 2 years. Demand is way up. It's just happened. And therefore, supplies in general have become more scarce. And there was another big event that happened just over a year ago, which was the Texas freeze that affected a lot more supply chain issues than people even realize. All those things together, three things together, affected our supply chain issues. None of those that I just mentioned are due to COVID. We have to be able to show suppliers were restricted due to a government mandate for that to trickle down to us, for us to qualify. That I wanted to address because that is, in my mind, a misconception going on out there. Now, customer base effect. IRS has specifically come out and said, hey, if an employer suspends operations and this affects you, if let's say a business was suspended and you sell to this business, they were suspended by a government mandate, so that reduced your sales to them. IRS specifically has said, sorry, supplier, you don't qualify because of that. This is directly after they say supply chain issues can qualify you. Customer base, they say, can't qualify you. Now, I'm bringing this up because I think, and we feel comfortable that there is a customer base effect that can allow you to qualify. And so let's give you an example. Well, let me give you a general. In general, if the place you earn your income was under a restriction, we feel comfortable that that has affected you. And I give you two examples here. I have a valet company. They park cars at restaurants. Restaurants were closed really at some level universally around the country. Other places longer and more impact than others, but around the country, there was usually some level of closure. The valet was not closed. The valet could go stand outside that restaurant all day and park no cars, but they weren't specifically under a restriction. But our argument is their place of business is the restaurant, and the restaurant was under restriction. Therefore, that qualified them. Same thing for, let's say, a caterer. You know, they only sell to convention centers. They cater for conventions only. Conventions were under restrictions. They weren't happening. That caterer's place of business was under a restriction. We feel comfortable with that. But in general, hey, schools were closed and I supplied to schools and I couldn't because of that. Well, that's really not your place of business. Your place of business is whatever the products are you're manufacturing, let's say, to sell to school. And unfortunately, IRS has come out with, I think, an incorrect stance, but it is the stance and it is guidance. It's an IRS notice. It's small guidance, but it is guidance. And so at this point, I feel we need to follow that. My hope is we'll get better clarification on this going forward. We are not under any time restrictions right now for filing even the very first ERC that a client was eligible for. We still have till July of 23 before we hit any deadlines. That's another misconception out there. And you've probably heard it. I've heard it. It happened a lot at the end of last year. We have 2 weeks to file this. I need to get this done now. We have no current deadline. There is no pressing deadline to file any of the potential ERCs at this point. So just be aware of that. I'm just going to touch on this quick. Wages, more than 50% owner of a business, you can't use their wages in the calculation of the credit or their relatives and wages. And what happened to this was not Congress's intent, and I've heard directly this was not their intent. Unfortunately, the code that they pointed to caused this. Their intent was not to hurt family-owned businesses. They've done that with this. That's what's happened. If you're a family-run business, you probably not, if family run operated employees, everything, you're probably not getting the credit, which you deserve the credit. So that's unfortunately. Tips are included. So for the restaurant industry, bar industry, tips are included as a qualified wage. And just as a side note, tip credit and ERC, you can do both. You can double dip there. Now here's some information that's interesting. We talk about double dipping with different credits and incentives. So the Shutter Venue Grant and the Restaurant Revitalization Fund, if you receive those, you can actually double dip the usage of those funds in the first 2 quarters of 21. But then the second 2 quarters of 21, you cannot. And so really, if you've got both of these incentives, and if you can, and most clients can, don't use any of the expenses eligible for ERC. Don't use any wages to satisfy the Restaurant Revitalization Grant or the Shuttered Venues Grant. Don't use any of those until 2022 or starting in the 4th quarter of 21 if you didn't qualify as a recovery startup business. Use them then, and we have a lot of freedom. And obviously the first 2 quarters of 21, we have those eligible. So just be aware that double dip is allowed for a while and then not allowed for a while. Here's a big one, and we all know this exists. Let's talk about realistically what we should be doing for our clients. So IRS came out in 2021 or 2049, which was what, the last year, sometime later in the year, their IRS notice, and they said that we have to reduce the expenses in the amount of the credit for the year those expenses were used in the credit calculation. So 2020 wages were used for 2020 credit. We have to reduce expenses on the 2020 income tax return. So what does that mean to us? Most taxpayers did not claim a 2020 credit until the year 21. It just didn't happen. And if they claimed it in the year 21, they may not have seen those refunds yet. A lot of clients are still waiting on refunds, which Nick's going to address at the end. So we probably filed the 2020 return without making an adjustment to expenses on that income tax return. What should we do? Well, this is not guidance. This is me saying what I think maybe should happen. You have to decide yourself. But at this point, I would not make any amendment on any 2020 returns. Again, my personal, not guidance to you. I would not make any amendment on the 2020 returns till you receive those refunds. Let's make sure we get them. Let's make sure we get the right amount. Let's make sure we have cash in hand before a taxpayer has to go back and pay income taxes on something they haven't received. That's what I would do. IRS has said that really it looks like there's going to be no penalties on this for doing it that way, even though they didn't pay the taxes when it was due. That's the way I would look at it. For 21's a little different, because 21 now, we've known, we probably took the credit in a lot of places, not everybody, but we took the credit in the year 21 or right after the year 21. We know the amount of the credit. We knew it. We knew what IRS wanted us to do before we filed the income tax return. And so what do we do about that? Well, if you've extended the 2020 return, I would probably do the same thing we did with the 2021 return. I would probably do the same thing we did in 2020. Wait till the deadline. And if we haven't received the refunds, then we probably put it on that return. IRS is going to send a notice. We're going to have to explain the whole situation to them. And we'll try to explain it ahead of time. We didn't pay this because we're waiting on the ERC refunds. If you have extended it to that, if you have filed without this, I'd probably still wait for the returns. If you haven't filed and we don't get the money by the due date of the extension, that's decision time. Maybe IRS will give us some more guidance at that time, but this is where we sit, unfortunately. I want to bring this up. I highlighted, this is not authoritative. I'm actually going to start to run out of time here, and there's a few key things. I just want you to be aware of. IRS has talked about this same type of concept that we just mentioned above when it comes to the work opportunity tax credit, timing issues on claiming the increase in income or the reduction in expenses. Well, that was a tough one for WOTC. And what they've said to their auditors in the field, if you see this timing off and they're adjusting the expenses in the year they received the credit benefit rather than the year that the wages were used for the credit, let it go. Don't worry about it in an audit. Not authoritative, not something we can rely on. We can know what IRS does with WOTC. Hopefully their mentality is do the same thing with ERC, especially if the commissioner wants to get caught up by the end of the year and this happens. I can't imagine they're going to want to put more burden on the IRS, more burden on taxpayers, more burdens on CPAs by having to go back and make a bunch of adjustments on this. I am not telling you can do this, and I have not seen it happen yet, and we will see it happen, but it's never going to be guidance, unfortunately. Polling question number 3. Let's pull this one up. I'm going to be surprised what this one says because I don't remember, even though I wrote it an hour ago. Are you doing more extensions today than 3 years ago? I'm just curious if the pandemic has created just this mindset of we're always going to delay, or we're always, clients for one coming in later, or to just let's give us more time to file the returns, and we're used to what has happened in the last year. All right, or the last 2 years. I want to go through this pretty quick. So we're 84% answered on this. And you're not paying attention right now. You need to go put in polling question number 3 answer, because we're only at 84%. We've been well over 90 on the other one. So I need everybody's answer in here, or you're going to have to make sure you answer the last one if you didn't answer this one. We want to make sure everybody, CPE is key. I want everybody to get their CPE. I want this to be educational. I want you to be entertained. I want you to get your CPE, because I know that's a pain to have to try to catch up at the end of the year, which unfortunately I personally have done a few times. Well, I'd be lying if I say a few times, multiple times. All right, we're at 88%. I'm going to end this thing and just let you know that at this point, 68% of you are doing more extensions. 6 are saying no, and 25% about the same. So yeah, I had a feeling there's going to be a lot more extensions going forward, and we'll see how that happens, what happens with that. This is an interesting area. I'm not going to spend a ton of time on this because I want to get to Nick's portion. Credit ordering. This is interesting. This somewhat surprised us because what happened is, I think it was 2120, IRS notice came out and said, hey, you can't double dip with these things. Okay, that made sense. You can't double dip with R&D. You can't double dip with Indian employment credit, active duty military credit, family, all these things you see at the bottom. You can't double dip. And it said, basically, if you use these wages for ERC, you can't use it for this other credit. Okay, that makes sense. We understand. Well, what happened with 2149, they said is, all right, we're going to change this rule these same credits, and they added a couple, but these same credits you can't double dip with, but we're going to inverse the order that we're saying this. The original, we said you can't use, if you use it for ERC, you can't use it for these other credits. Starting in the third and fourth quarter, they say if you use it for these other credits, you can't use it for ERC. It may sound like, well, what does that mean to me? Well, it can mean a significant reduction in overall credit for your overall benefit with all these different credits. And it's a strange verbiage that they use here. So I can't go into this deep right now. We can go into this deep if anybody wants to talk about it further, but realize that this is out there. And they specifically say in their footnote to this 2149, inverse order. We're doing this in inverse order. And then when the IRS put out the rules, the instructions for the R&D tax credit, which was one of those credits, they say, okay, if you had ERC the first 6 months, here's what you do. If you had the second 6 months, what you had to do. So it was really highlighted there that this is something different. It kind of looked like it was the same terminology, just said a different way. But if we look at what they're saying and we use this inverse order, and we have to, under the prior law, let's assume prior law stuck. I just did a quick example here. I'm not going to go through it, but the prior law stuck. We have an R&D employee. We have an ERC employee. That's one employee, first line. Their overall credit for that employee, if the old law just stuck, was $26,000. Based on the new ordering, in the third quarter, I have to use their wages for ERC first, which is weird because we don't know R&D wages till the end of the year. We knew ERC wages in the third quarter, but what they're saying, I have to use these wages for R&D first. Overall benefit for this employee would have went down to $20,000. So it negatively affects certain employees because of this footnote in 2149 that says use the inverse order of using wages for credits. Just be aware it's there. If you have this situation, we could talk about it further. But that's what I want to let you know. And it's not just ERC, it's other credits as well. I want to get to Nick's section right now, where we're going to talk about the changes to 941, because there's a lot of confusions here. And I personally, I don't touch the 941s. I didn't even know that this was there until Nick was telling me a couple of weeks ago. So Nick, why don't you let us know what happened with the 941s?
Yeah, absolutely. So with the 941s, when we're looking at the main two things the worksheets interact with is FFCRA credits and ERC credits. So when we're looking through them for all of 2020 and through Q1 of 2021, there's always a non-refundable and refundable portion. The non-refundable portion is simply, it's counting against the employer's Social Security tax. And this isn't, the non-refundable term is a little confusing. It's not actually reducing the credit your client's receiving. It's just a term the IRS uses because it's against an actual tax versus the rest is just a cash credit coming back to you. So for all the first 4 quarters qualifying, essentially everything was counting against employer Social Security tax for the non-refundable portion of the credit. And then in Q2 2021, FFCRA flipped to the non-refundable being calculated against Medicare tax, while ERC remains against Social Security tax during that quarter. And then in the third quarter of 2021, they both got counted against the Medicare tax. So you may look at this and say, okay, well, if it doesn't change anything, what does this mean and why is it important? The reason why it's important, and Randy, if you want to go to the next slide real quick. So essentially, we have had cases where the IRS has rejected something if the non-refundable portion is not properly broken out for the credit. So unfortunately, we can't just take the whole thing and say, well, they already filed, so the tax is already paid, so we're just going to put the whole thing as refundable. It's not always working that way. We actually have had some that, cases where we've seen that get accepted by a client. But for the most part, we have seen those also come back as well. So just to make sure that we're doing everything we can to make sure clients get their credits as quickly as they can, we want to make sure we're taking this into account. So the next 4 pages, I just took a couple of snippets of the worksheet just to point out. So you can see here, we're looking at worksheet 1. And for worksheet 1, you have the up top, it's always talking about Social Security tax. Obviously, this is FFCRA through the first quarter of 2021. On the bottom, you have the non-refundable portion that you calculate, which is essentially the portion that's equal to Social Security tax up to that amount. And then the rest above that is the refundable portion. Again, just terms, not changing how much your client's getting back. It's just the terminology that IRS is using, and they want to see you break it out on the 941X, even though it's amended and not timely filed. So then worksheet 2 is the ERC side of things. And what comes into play here is we actually have to take the non-refundable FFCRA and reduce the non-refundable ERC by that amount up to the Social Security tax. So it can get a little bit confusing, right? All the calculations from the worksheet for actually figuring out what the ERC is are relatively simple. It's just that breakout and making sure in worksheet 2 you're accounting for the FFCRA that was taken up to Q1 2021. Q2 2021 FFCRA though switches to worksheet 3 instead of worksheet 1, while ERC is still on worksheet 2. So you have this one line here that I've got a couple questions on, 2N, and it says for the second quarter of 2021 only, enter any employee retention credit claimed under the CARES Act with respect to wages taken into account for the qualified sick and family leave. So essentially what this is saying is if you double dipped, you need to reduce it by this amount. Now, when we do these calculations, we're making sure we're not touching the FFCRA wages with qualifying for ERC because there's more value to the FFCRA. It's a dollar for dollar as opposed to ERC wages. It's a reduction. So you want to take the FFCRA as much as you can, but if there is a point where you do double dip, in this scenario, it's actually making you reduce your FFCRA by ERC taken. So something to be aware of for Q2 2021 that could affect it. And then this is in Q2 for FFCRA, it's looking at the employer share of Medicare tax for the non-refundable portion versus on the ERC side, we're still looking at the employer share of Social Security tax, filling out the form. So in this quarter, they're not having to reduce each other as opposed to the other quarters they were, because they were both against Social Security tax versus now one's Medicare tax and one's Social Security tax. Again, the non-refundable, refundable, it doesn't seem like it should be a big deal, but we have seen a couple get rejected because of this. So I just want to make you guys aware of that. And then when we get to Q3 and Q4, if you have a recovery startup, you get to a situation where they're both based on the non-refundable being based on the Medicare tax instead of Social Security tax. So now it goes back to having the interplay back and forth. So now here again on worksheet 4, 2F, now you need to reduce it by the FFCRA non-refundable amount taken. So just wanted to point out the interplay. Again, doesn't change the credit your client's getting, just something the IRS wants to see. And we have seen scenarios where they kick it back if you're not filling that out. And then so timing and tracking refunds with the transcript delivery service, we've seen that it's about 3 months before it's even showing up as being received by the IRS. And this can cause some clients to be asking questions for where their return's at. We just have to be patient. We could try calling the IRS, but sometimes they still don't have it showing that it's received. So from the time we send the forms in the mail for a 941X, we're seeing 5 to 6 months processing on smaller credits. We do have some clients that are taking as long as 10 months and more. As of now, we still have not gotten them. We have confirmation the IRS has received it. They just haven't processed it. I don't know if it's because of the size of the credits or what. We can only speculate. But we do think that there is a level threshold where once credits get over a certain amount, they are going through a second review or a longer review process as opposed to smaller credits. So that is something to be aware of when you're filing with your clients. It can be a long timeline if you're talking, a couple 100,000 credits. We've seen, I think the largest credit we've seen in a 6-month time frame is around 250,000 or so. Most of the larger ones are taking a little longer.
I'm going to launch poll 4 while you're talking, Nick, unless you're done.
No, that was pretty much it.
Okay, well, thanks, Nick. And as poll 4 goes out there, would you be in favor of extending the due date of tax returns? We kind of got used to this last year. I know this is a very topic where not everybody agrees on. And so I'm just curious where you sit. While you're answering that, I'm going to leave that up for a little bit. I mentioned at the beginning that we have a lot of new stuff going on from a CPE standpoint. I just want to let you know, we are going to add a second monthly webinar. We've been doing one a month for 2 years now. We are going to add a second. The second webinar is going to be a guest speaker that's going to talk about various topics within that are, obviously within the industry. I said industry. We said I need to call this the accounting profession at the beginning. Within the accounting profession, our first speaker this will start in May. Dan McMahon's going to be the first from Integrated Growth Advisors. He's going to be talking about building a sustainable and transferable firm. And by transferable, he doesn't mean you need to sell to someone else. This means, potentially it's that, but he means you're ready to be taken over by the next generation of partners within the firm. So Dan will be the first speaker, and I'm excited about that. I want to let you know that we are having our second annual conference. We had the first one last year, the Unique CPA conference. This year it's going to be November 30th and December 1st. Before I even go on that, I forgot to announce Barry Devine is on here as well. Barry's probably been answering some questions. Barry was integral in getting our ERC program set up. So thank you, Barry. Here's our conference. I just want to show the speakers we're having. I don't think you can find a better group of 10 speakers. Well, I put myself in there. Let's say 9 speakers anywhere in the industry. We have great information that's going to be shared in this conference. This is free. This is us giving back, and we really, really appreciate it. If you were on last year's, I think you'll understand you got a lot out of it. And then the last thing, to sticking with the theme of giving out quality CPE for free, the Unique CPA podcast is now on an app called Earmark. Earmark turns the podcast into CPE. And so you can now get CPE for listening to our podcast, the Unique CPA. I gave you the link there where you can go download the app. You can listen to episodes. You have to answer a few questions at the end of listening. And again, free CPE available. So if you're out jogging, you're out for a walk, you're hiking, you're on the exercise bike, treadmill, and you want to listen to some CPE, you could be earning some podcasts. You can earn CPE while you're listening to that. I'm going to end this poll. We have 100% participation. Look at that. And we have 55% of you say, yes, you're in favor of extending tax season. And I think I would agree on that as well. This has been awesome. I appreciate everybody's attendance. This is still a hot topic. And so if anybody has any questions on ERC, if I can't answer it, Barry or Nick can, and we will get back to you. There's my information, but I want to let you know on the next slide, you can scan that QR code. That'll take you to our website. You can find, I think it's a Meet the Team tab, I think is what it's called. Everybody's contact information's on there. We just want to be there to support you with any questions and make sure ERC is done correctly, because unfortunately, I'm a little concerned that I'm seeing some ERCs being taken that don't exist, and that's going to be a problem down the road, especially with this 5-year audit period. Again, thanks everybody. Thanks Nick and Barry for being part of this. Thanks Mark Reese for helping facilitate this. Have a great rest of your tax season. Goodbye.